Most people are asking the wrong question. They're asking, when is the next recession? That's like standing on a melting ice sheet and asking when the next snowstorm is coming. Because what's happening right now isn't a downturn. It's not a cycle. It's not something the Federal Reserve can fix with a rate cut. It's a change in the rules of money itself. If you've been saving responsibly, if you've been maxing out your 401k, if you've been doing everything your parents, your employer, and every financial advisor told you was the smart thing, there's a real chance you're preparing for a future that no longer exists. This isn't about stocks crashing tomorrow. It's not about panic or conspiracy theories. And it's definitely not about gold bars or living off the grid. It's about something quieter and more dangerous. The measuring stick we use to judge wealth, safety, and retirement is shifting. And most people won't notice until years of progress quietly disappear. If you want to understand what's really happening, stop watching headlines about soft landings and temporary inflation. Start paying attention to how money systems actually change. Because when the game changes, effort alone isn't enough. You need to know which game you're playing. Most conversations about the economy stay on the surface. Is inflation coming down? Will the Fed cut rates? Is the next recession 6 months away or 12? Those questions dominate financial news because they're easy to discuss and comforting to answer. They imply that what we're experiencing is temporary, that if we just wait long enough, things go back to normal. But history shows something uncomfortable. The biggest financial disruptions don't come from recessions. They come from structural shifts, moments when the system itself stops working the way it used to. Think about it this way. A recession is like getting sick. You rest, recover, and go back to your routine. A structural shift is like discovering the climate has changed. You can't just wait it out. You have to adapt. Right now, most people, including many professionals, are still using a business cycle lens to analyze what's happening. They're looking for signs of recovery, relief, or reversal. But the real story isn't happening in quarterly earnings or unemployment numbers. It's happening underneath the surface, in how governments finance themselves, in how trust in currencies slowly erodes, in how global trade settles payments, in how central banks respond when old tools stop working. Mainstream narratives focus on outcomes, prices, markets, headlines. They rarely examine mechanics. And when you don't understand the mechanics, you misinterpret the signal. You assume higher prices are temporary. You assume lower bond returns are an anomaly. You assume your retirement math still holds. This analysis uses a different lens. Instead of asking, when does this end? We're asking, what system are we transitioning into? That shift in perspective changes everything. Let's ground this in verifiable events, not opinions. In March of 2020, the Federal Reserve expanded its balance sheet by roughly $4 trillion in just 8 weeks. That was the fastest monetary expansion in U.S. history. It wasn't a stimulus cycle. It was an emergency response to prevent a complete financial freeze. In 2021, the U.S. government sent trillions of dollars directly into the economy through stimulus checks, enhanced unemployment benefits, and business support programs. A significant portion of that money went to households that never experienced job loss. This dramatically increased aggregate demand at a time when supply chains were already constrained. In 2022, Russia was removed from the SWIFT messaging system following its invasion of Ukraine. This marked the first time a major G20 economy was effectively cut out of the dominant global financial plumbing. In response, Russia accelerated bilateral trade settlement in non-dollar currencies, particularly with China and India. In 2023, multiple large emerging economies, including China and Brazil, publicly announced energy and commodity trade settlements using local currencies instead of US dollars. These agreements did not replace the dollar overnight, but they reduced marginal demand for dollar settlement at the edges of global trade. In 2024, central banks purchased over 1,000 metric tons of gold, one of the highest annual totals since the mid-20th century. Notably, these purchases were concentrated among countries seeking to diversify reserves away from U.S. Treasury securities. This data comes from publicly reported central bank reserve disclosures. Meanwhile, U.S. federal debt exceeded $36 trillion, placing debt to GDP near historical highs outside of wartime. At the same time, interest expense on that debt rose sharply as Treasury yields increased. By early 2026, yields on the 10-year Treasury remained elevated relative to pre-pandemic norms, even after inflation had eased from peak levels. Separately, wealth concentration continued to widen. The top 1% of U.S. households now control roughly one-third of total household wealth, while the bottom half controls only a small single-digit percentage. This data is consistent with Federal Reserve distributional accounts. None of these facts are controversial in isolation. What's important is their timing. They are not spread out across decades. They are clustered within a 5 to 6 year window. That compression of monetary expansion, geopolitical realignment, debt accumulation, and reserve diversification is historically unusual, and it's the context most people miss. Taken individually, none of these events signal a collapse. But when viewed together, they suggest something more subtle and more important. One possible interpretation is that the global financial system is entering a trust renegotiation phase. For decades, the US dollar has functioned not just as a currency, but as infrastructure. Governments hold it, commodities are priced in it, debt is issued in it, not because it's perfect, but because it's predictable and liquid. However, large-scale monetary expansion changes how that trust is perceived. When a government issues debt faster than global demand for that debt grows, someone must absorb the difference. Increasingly, that role has been filled by domestic institutions and central banks. This may indicate a shift from market-driven financing toward policy-driven financing. From a strategic standpoint, that matters. It suggests the cost of capital is no longer being set purely by investors, but partially by political necessity. Over time, this can reduce the signaling power of interest rates and weaken confidence in long-term price stability. At the same time, the use of financial sanctions as a geopolitical tool introduces a new risk variable. If access to payment systems and reserve assets depends on political alignment, it's rational for countries, even neutral ones, to explore alternatives. This doesn't require hostility toward the U.S. It only requires risk management. Gold accumulation by central banks may reflect this mindset. Gold carries no yield, but it also carries no counterparty risk. From a strategic perspective, it functions as insurance against financial fragmentation, not as a bet on inflation alone. Similarly, bilateral trade settlements in local currencies don't replace the dollar system. They reduce dependency at the margins. Over time, marginal changes can alter equilibrium behavior, especially if repeated across multiple regions. Another interpretation is that we are seeing a transition from a single anchor system to a multi-anchor system, where no single asset or currency fully dominates global settlement and reserves. If that's the case, the adjustment wouldn't be sudden. It would be gradual, uneven, and difficult to measure in real time. Markets may continue functioning normally while underlying assumptions quietly change. In that environment, volatility doesn't come from panic. It comes from repricing. Assets valued under old assumptions adjust to new constraints, not because anyone intended harm, but because incentives shifted. That's how systems change without announcing themselves. If this interpretation is even partially correct, the consequences extend far beyond markets moving up or down. They affect how the entire financial system behaves. Start with markets. In a world where capital was abundant and inflation was low, asset prices could rise steadily. Valuations expanded because future cash flows were discounted at very low rates. If capital becomes more expensive or less predictable, that math changes. Not overnight, but persistently. Markets don't crash because something is wrong. They adjust because the assumptions underneath them are no longer valid. Now look at banks. Banks operate on confidence and duration. They borrow short and lend long. When interest rates rise and remain volatile, that model becomes harder to manage. We've already seen how quickly stress can appear when asset values shift faster than balance sheets can adapt. In a structurally higher rate environment, banking risk becomes less about bad loans and more about mismatched time horizons. Next is currency. A reserve currency doesn't disappear suddenly. It slowly loses exclusivity. Trade settles in more currencies. Reserves diversify incrementally. This doesn't collapse the system, but it reduces the automatic demand that once stabilized it. When demand becomes conditional instead of guaranteed, currency strength depends more on policy discipline than on legacy status. Then there's government finance. When debt levels are high, governments become sensitive to interest costs. That can limit policy choices. Raising rates controls inflation, but increases debt service. Lowering rates eases debt pressure, but risks currency weakness. Over time, This creates pressure to manage outcomes rather than allow markets to fully express risk. Finally, the global order. The post-World War II financial architecture was built around a single center of gravity. What we may be moving toward instead is a fragmented system, regional, negotiated, and less standardized. That kind of system still functions, but it's less efficient and more political. None of this implies collapse. It implies friction. And friction changes how wealth is preserved, how risk is priced, and how long-term plans play out across decades instead of quarters. Here's where all of this stops being abstract. Because macro shifts don't show up as headlines in your life. They show up quietly, in ways that are easy to rationalize. They show up when your grocery bill rises a little faster every year, when insurance premiums jump even though nothing bad happened, when rent, property taxes, or college costs keep outpacing raises. On paper, everything looks fine. In reality, the gap keeps widening. For savers, this matters more than most people realize. If inflation runs slightly higher for a long time, not dramatically, just persistently, the real value of savings erodes. You don't feel poorer all at once. You feel like progress slows, like doing the right things doesn't move the needle the way it used to. For investors, especially retirement investors, the risk isn't a crash, it's expectation mismatch. Most retirement planning in the US is built on assumptions formed during a very specific period. Stable dollar dominance, falling interest rates, bonds acting as shock absorbers, stocks benefiting from cheap capital. If those conditions weaken, even gradually, portfolio behavior changes. Returns may be lower, volatility may feel different, diversification may not work the way the spreadsheets say it should. For workers, this shows up in job dynamics. Periods of structural transition often come with technological pressure, cost-cutting, and uneven opportunity. Some skills become more valuable, others stagnate. Job security feels less predictable, not because the economy is bad, but because it's reorganizing. And for families, the long-term question becomes harder to answer. What does stability actually mean? Is it a number on a statement? Is it a career path? Is it flexibility? The uncomfortable truth is that many people won't feel this shift until years have passed. By then, the math has already compounded in a different direction. That's why awareness matters more than prediction. You don't need to know exactly what happens next. You need to understand the environment you're operating in. To make sense of environments like this, I use what I call the structural lens. It's not a forecasting tool. It's not a portfolio model. It's a way to filter noise from signal. The structural lens asks three simple questions over and over. First, is this problem cyclical or structural? Cyclical problems repeat and self-correct. Structural problems accumulate and force change. Confusing the two is how people prepare for the wrong future. Second, who is forced to act and who has the flexibility to wait? In any system under pressure, the most constrained players reveal the truth. Watch who needs cheap financing, who needs stable currency demand, and who cannot tolerate volatility. Their behavior tells you more than their words. Third, what assumptions are no longer being questioned? Every stable period creates blind spots. When everyone agrees something is safe, normal, or guaranteed, that's usually where risk quietly builds. Using this lens shifts your focus. You stop obsessing over next quarter's GDP print. You start watching long-term incentives. You pay attention to how debt is financed, not just how much exists. You notice when policy choices trade long-term stability for short-term relief. You track what institutions do with their balance sheets, not what they say on television. Most importantly, the structural lens removes urgency. It doesn't tell you to act fast. It tells you to observe clearly. Because in slow-moving transitions, the people who win aren't the ones who predict perfectly. They're the ones who avoid building their lives on assumptions that no longer hold. This framework isn't about fear. It's about orientation. In environments like this, the goal isn't to predict outcomes. It's to reduce dependence on fragile assumptions. Start with how you observe. Instead of watching daily market moves, pay attention to structural signals. How governments finance deficits. Who is buying long-term debt and who isn't. Whether policy responses are proactive or reactive. Whether problems are being solved or postponed. These patterns tell you more than headlines ever will. Next, think in terms of duration risk, not just market risk. Ask yourself, where am I exposed to long timelines that assume stability? Long duration bonds, fixed retirement projections, career paths that only work in one economic environment. Shortening duration doesn't mean panic selling. It means valuing flexibility. Then focus on resilience over optimization. The last few decades rewarded efficiency. The next may reward redundancy. That could mean liquidity over maximum return, skills that transfer across industries, income streams that aren't tied to a single employer or policy regime. It also means being cautious with leverage, financial and psychological. High leverage works beautifully in stable systems and brutally in shifting ones. Another overlooked area is expectation management. If you assume the future will look like the past, every deviation feels like failure. If you assume change is part of the environment, adaptation becomes normal. Finally, remember this: no system transition is clean. No adjustment is perfectly timed, and no one gets every decision right. The advantage doesn't come from certainty. It comes from not being blindsided. You don't need to overhaul your life. You need to stop outsourcing your thinking to models built for a different era. That alone puts you ahead of most people. Most financial damage doesn't come from bad decisions. It comes from outdated assumptions. People do what they're told. They save. They invest. They stay disciplined. And for a long time that works because the system rewards those behaviors. But systems don't last forever. They evolve, they adapt, and sometimes they quietly change the rules without announcing it. When that happens, the people who struggle most aren't reckless. They're responsible. They're the ones who trusted that yesterday's logic would still apply tomorrow. This moment doesn't require panic. It requires awareness. You don't need to predict the future. You don't need to abandon everything that worked before. You just need to recognize when the environment has shifted. Because wealth isn't just numbers on a statement. It's purchasing power. It's optionality. It's the ability to make decisions without being forced. When you understand the system you're operating in, you stop reacting and start positioning. And that's the difference between feeling anxious about what's coming and being prepared for it.